potential assumable mortgage for the home buyers.
This is a great thing to talk about. An assumable mortgage is a specific type of mortgage agreement where instead of just taking out a new mortgage, I'm going to make up numbers in a second, you can, instead of taking out a whole new mortgage for the full price, you can assume the seller's portion of their mortgage. And it's not available for all loans. It's going to be available on those government loans. But when interest rates are 7-8%, high interest rates, and just a couple years ago, people had bought homes at 2% and 3%. There's a huge benefit to assuming one of these loans. Now, what are the loans?
Exactly. The loan actually is the loan that is covered or backed by the government, like FHA, VA, and USDA loan, which is backed by the government.
And you do not have to be a VA to assume, the veteran to assume a VA loan. That's something else just kind of there.
But what you need to remember that my wife wanted to make example, let's say you are interested in a house that really worth right now $500,000, but the buyer with the VA loan, the seller with the VA loan
or
FHA had the interest rate of 2 to 3%. Now, that he has $400,000 now, his house appreciated to $500,000 that you wanted to purchase. Now, based of this, potentially you can assume that $400,000 with the interest rate that the seller had initially, and the remainder of balance that is $100,000 is going to be the second loan, which is with the market value in the market.
Right, so there is a tremendous, basically at the end of the day, your monthly payment, if you take these two loans instead of just one, is going to be much smaller. So that's a great thing to have instead of just taking $500,000 at the higher interest rate. But before we get into more details about the different mortgages and how they work, we need to do our introduction.
Let's hit it!
Hi, it's Alan Pittore. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get to it.
Honestly, call us text all the time at 252-327-3357. We love talking to you. Don't be shy. Also, don't forget our buyer's guide and seller's guide in the description below.
Exactly. Therefore, we talk about that these type of loan should be backed by the government, which is the USDA, FHA, and VA loan. And my wife said that if you are not VA, still you can actually continue with that.
But they first has to allow it. There are some rules there.
Yeah, exactly.
So let's talk about it. FHA, everybody has to qualify for FHA to assume this loan. So if you don't qualify for FHA on your own, you're not going to qualify for assuming the mortgage for somebody else who has an FHA. So it has to be your primary residence. It has to be that you have the credit worthiness, the debt to income ratio. You have to assume that you can qualify for that FHA loan.
And the major role is the seller's lender, really, because that is the person that actually qualifies you for that. You can assume the mortgage of the seller.
Right, so that means that I'm going to make up an example of ABC Mortgage. So the seller used ABC Mortgage to buy their home. You have to, maybe you want to use XYZ Mortgage for your loan because that's who you've been talking to. We still need to go to ABC, and you're going to have two loans for FHA for that imaginary house that we were talking about before. Maybe it's less or whatever, but you're going to have two bills, and you have to qualify with ABC and XYZ.
Exactly. Therefore, this is the dilemma here that you're dealing with. You need to deal with the two companies at the same time.
And that's dramatic if you already are someone who has to get it. But if you like just grabbing your papers and sending it as is, and you can send it to two instead of one, it's fine.
The second type of loan that we wanted to talk is a VA loan. What is about the VA loan?
Now, VA loans are specifically made for veterans and their surviving spouses. The veteran, you have to have approval from the lender and the VA office in order to transfer it to somebody else. It is possible. It is not easy. And this is actually the hardest loan, I would say, to transfer to somebody else. So don't assume a VA loan is easy. That's the hardest one to meet because the VA has to approve that you're going to take over that loan.
And this rule really is post-March 1st of 1998, this rule, 1988, that this rule came for the VA loan that you need explicitly approval from both lenders and regional VA loan officer for transfer of the loan to you from the seller.
I would say say, going back to the other qualifications, if you want to go to USDA loans, sorry, I want to go to the next one, USDA loans. USDA loans typically have higher credit worthiness than your FHA, generally speaking.
Yes.
It is targeted to rural areas, so that house has to be in a very specific area. Maybe this person put no down payment down when they bought the home, they got the lower interest rates, but assuming this means that you still have to have the higher credit score and you still have to meet the income requirements in order to get the USDA to approve you there. So again, you're going to two lenders, just like we talked about with the FHA. You're talking to the original USDA lender, you're talking to your lender to see if everything can mesh well together.
And if you're in your mind thinking about the conventional loan and thinking that can I use assumable mortgage, the quick answer is no, because assumable mortgage, conventional loan is backed by the Fannie Mae and Freddie Mac, and they don't allow basically that you do assume the mortgage from the buyer.
Now let's talk about the pros and the cons. So
yes.
The pros. You're going to get that 2.5%, 3% interest rate on each chunk of your mortgage, which is going to have instead of having a $3,000 payment or $4,000 payment, whatever it is, your interest rate with that lower interest rate is going to be much, much lower. So you're going to save every single month. What are the cons?
The cons is basically you need to basically look at your credit worthiness and your credit check twice.
Two lenders.
Because one is from your original lender that right now you're working, and also one from the seller's lender. That it depends on is a VA, FHA, or USDA.
You also have to deal with two different lenders. Can be super tricky. Mm-hmm. Some of them might require a bigger down payment. So you just have to know what both people are talking about. It's not just two parties in this, a buyer and seller. The original lender has a lot of say, and that is something that can put the red light on assuming a mortgage.
Okay. Do you want to add anything else?
No, I think we're good. You want to talk about anything else? Most loans are not assumable, but
exactly.
Some are, and some can be an amazing benefit to you.
I hope you love this video and podcast, and don't forget to call us at 252-327-3357, and also leave us a comment and subscribe in our channel. We love to connect with you. See you in the next podcast and video.